and heard either of my two sessions know full well that I stood up in front of all you in March last year and basically said, look out, because the world could be in trouble, and we may well be in the midst of a deleveraging depression dynamic that could cause stocks to continue to fall in a much greater degree. And lo and behold, what happened? I walked out of here and global central banks and governments responded in a way that is unprecedented. And as a result, what happened? Markets went straight up 40%. Now, I say that not just to eat a big slice of humble pie, which is probably appropriate, but more importantly, I think it serves as a good indication as to how difficult it is as investors to consistently predict what the future is going to look like. And so active management, whereas it is a great source of return for those managers that have demonstrated on a successful basis, still is a small amount of risk for most institutional investors globally. And most of the risk is really devoted towards the asset allocation decision. What's my long-term strategic mix of assets that's going to deliver me the best performance within my pre-specified risk budget? And what I want to do this morning is not focus on active management and where markets are necessarily going, but more to look at that asset allocation decision, try to look at the way it's been conducted in the past, and try to illustrate how the GFC has helped to expose some vulnerabilities in that. So I'm going to really talk about three things. One, I just want to briefly review what happened to performance during the crisis. I think people know, but I think there are some longer-term implications which people don't totally appreciate. Secondly, I want to talk about, okay, what are some of the contributing factors that led to that extreme underperformance? And then thirdly, given those factors, what is it that we as investors can do to try to maybe not eliminate losses in a crisis situation, but reduce dramatically the vulnerability in those types of situations, and yet at the same time still deliver superior performance over time. So first, let's just quickly look at performance during the crisis. And the first thing I did is I just wanted to take a look, okay, what was going into the crisis? What was the asset allocation in Australia relative to the asset allocation of pension funds in the US or in Europe? And what you can see here is they were pretty consistent. I mean, there's basically a mindset and a model that the world, the institutional world has adopted as long-term investors that basically, as you can see, puts a lot of the exposure and a lot of the money, a high percentage, in equities. And then some various mix. Europe maybe has a little bit less equities, more bonds, but basically the picture looks the same. As a result, during the crisis, no matter where you sat, if you were a typical institutional investor, you experienced the same kind of phenomenon. And that phenomenon was, and this we're just looking at, basically the time frame of the GFC, which arguably began roughly in July '07, and arguably is still going. It's not necessarily over by any stretch of the imagination at this stage of the game. But what did we see? Initially, we had a 30 to 40% drop in the value of pension funds, superannuation plans, because of the GFC. Now, subsequently, what happened, as I said, back in March, look at the timing. I was sitting here in March saying, look out, there's more, there potentially, worse things can continue to happen. And lo and behold, we got this rally, again, because governments responded in an unprecedented way, and markets back up 30 to 40%, right? So down 30 to 40, back up 30 to 40. Gee, that sounds like we're back where we started. But I think, as all of you know, that's not true, because you took that first 30 to 40% loss on a much bigger asset base, and as a consequence, to get the dollar value of your fund back up where it used to be, you need a significantly greater outperformance on the upside than you suffered on the downside. To get back to even in this situation, even though Australia and other plans had somewhere in the 30 to 40% recovery, it really takes over somewhere about 55% recovery to just get back to neutral. And what's important about that is, from a long-term performance perspective, it's these drawdowns that are painful and they're very hard to overcome, such that if we can somehow mitigate the depth of the drawdowns, the decline in value, it puts us on a much better path on an ongoing basis. As a consequence of what happened in the GFC, and I think this is something people maybe don't appreciate as much, we've had a very poor investment experience over the last decade. That effectively it's been a lost decade for investment. Why? Because of the big drawdown that we suffered. We had certainly a significant one back in the 02 type of era, but we also obviously had the major drawdown in the GFC, such that the return of the average or typical Australian superannuation fund basically mirrored cash. You took an enormous amount of risk, you had swings all over the place, and you'd have been just as good sticking your money in the cash account at the local bank. And that obviously has to be disturbing if you're in the superannuation business and you're trying to grow assets for the future. The impact of these kinds of drawdowns has even had, has had additionally a more significant impact even over the long term. Here's 40 years, long term, right? Okay, so we go through these ups and downs and things should be okay. But what you see here is that the excess return on average annually over the past 40 years has only been about 3% above cash. And more interestingly, the return to risk ratio. How much risk did I have to take to earn that 3%? As you can see, it's about a 12% risk level, which means that the return per unit of risk over 40 years has been about 0.24, which means if I want to earn 1% return and continue to do what I'm doing, I have to take about 4% risk. It's not a very efficient recipe. So that's what happened. Okay, now the question is why? And let's look at some of the contributing factors that led to the magnitude of the drawdown that we're seeing, and ones that we can probably take some active steps to help mitigate. And from my perspective, there really are two big areas that were lacking. One is the plans were not truly diversified, and when equities got hit, superannuation plans and other global institutional investors got hit very, very hard unnecessarily. And secondly, there was a liquidity problem, and it was particularly acute here in Australia, even more so than other parts of the world, and I'll touch on both. Let's start with the diversification issue. The left-hand pie up here is the amount of money that the typical superannuation plan in Australia has allocated to the various assets. The red are equity and equity related, whether it's public equity, private equity, et cetera, and then you can see the smattering of other investments. But what's important is this is the amount of money we have invested. But as investors, we don't earn a return based on the money we invest. We earn a return based on the risk that we take. And so when you look at a true picture of this asset mix in risk space, which is on the right, what you see is, lo and behold, over 85% of the risk of the typical Australian superannuation plan asset allocation is in equities. Why? Because you put the most money in equities, and equities, generally speaking, is the riskiest asset. And when you look at the picture this way, what you see clearly is the right-hand pie is not very diversified. All this other stuff, the green colors and the purple colors and whatever, it's probably fun to play in, but the fact of the matter, it doesn't have much of an impact on returns. And just to illustrate that, just took two examples, 2008, 2009. 2008 was clearly a year when equities got hurt. That was the big drawdown. And so what happened? Equities were down. The total return, the blue of the plan, was down. 2009, government stimulus. Markets rebound in a significant way. Equities do well. Plan returns do well. So lo and behold, we build this quote-unquote diversified asset allocation that isn't diversified at all and is basically solely dependent upon one asset class, and that's equities. But what's interesting is everybody, I think there's a notion, I've talked to a lot of people, well, there was no place to hide. No matter where you invested money, you lost money during the global crisis. And this is just to illustrate that that's not true. That for structural reasons that we'll talk about a little bit later, bonds, the blue line, actually did quite well during the GFC. Equities, commodities fell off a cliff that we all know, and inflation index bonds roughly went sideways during this period of time. So there were diversification opportunities available, yet the way plans were structured in this heavy equity orientation obviously What happened to equities is what happened to the plans. So that's the diversification side. Plans were not sufficiently diversified. Secondly is the liquidity issue. And what's interesting to me here is, there's been a notion, I think, over the years that pension funds, superannuation plans, endowments are long-term investors. As a result, long-term investors don't have to worry so much about liquidity. And I think the notion is embedded relatively deeply in what's called the U.S. endowment model, which everybody used to think was the big deal. The Harvards and the Yales were investing this way. They were buying lots of illiquid assets, taking the liquidity return premium, and as a result, generating higher returns relative to the others, similar type investors in the marketplace. And that was all well and good, except what the GFC clearly exposed in a crisis, liquidity matters, and it becomes a major problem. And to me, there were three sources of liquidity problems, two of them which are unique to Australia. One is common, pretty much around the world. The first that's common is in private equity and other certain types of hedge fund investments that aren't liquid. And in many cases, some of the hedge funds put up gates that wouldn't allow you to take your money if you wanted the money from an investment perspective. And the private equity, I think as most people know, not only were you looking for private equity to generate distributions to bring in cash, but also you've committed cash which they can take down whenever they want. And so you had the double-barreled effect in GFC. There were no distributions or very minimal distributions. As a consequence, there wasn't any cash coming in from private equity. And yet at the same time, the private equity world, now's a great time to make investments, so they start calling on equity. Required for those that had significant investments in private equity, required a lot of cash when cash was somewhat scarce. But there were other two things down here in Australia that led to even a greater problem. One is member choice. There were certainly plans where investors moved, and when they moved, you had to come up with cash to give them their cash. Okay, that's an added pressure that most institutional investors in the world didn't have. The third is, to me, even more interesting, and it's the currency hedging problem. In the early part of the crisis, I think as everybody here knows, the Australian dollar got hit very hard. As a matter of fact, if we look at it here, what you see is in the early part, the Australian dollar got hit very hard relative to other major currencies, the US dollar, et cetera, et cetera. And what happened for plans that prudently basically said, I've invested a lot in foreign assets, foreign equities or whatever, that's fine, but it's giving me too much currency risk, so I want to hedge it away. I want to hedge it back to Australian dollars. And so they put on forward contracts to sell the foreign currency that's embedded in the foreign asset and hedge back to Australian dollars, which in the long term is a risk-reducing strategy. The problem is a lot of money, a lot of hedges were put on, the Australian dollar collapsed, and that required a major cash output, cash flow out of the plan to satisfy those contracts. Now, economically, you weren't hurt so bad. Why? Because the underlying international assets actually appreciated in value. But that was a paper profit. The currency hedges were an actual cash outflow. So the economics aren't quite so bad, but the cash flow consequences were pretty severe. And I know, I don't know all the specifics, but I know there were rumors there were several plans that had to come up with over $1 billion of cash just to settle the foreign exchange contracts. So here you are in a situation where the foreign hedges obviously required major amounts of cash, and were there sufficient cash in the portfolio? In most cases not, because no one anticipated these kinds of events. Secondly, when I talk about the exposure to illiquid assets, the private equity and other types of hedge funds, this is, many of the, plans, even down here, had this kind of exposure up to 25 to 35% in very illiquid assets. So through member choice, FX hedging, I need cash. Here's a whole big part of the portfolio where I have no access to it. And in cash, in fact, can even generate a greater cash return. And so as a consequence, what I saw, and many of you, of the plans themselves that are here, even if you wanted to do something during the crisis to alter the asset allocation, the cash wasn't there. to allow it to happen, and the liquidity problems dominated what was going on and destroyed flexibility in the plan. So liquidity matters. And all I would say to that is not to invest in these things, but when one does, be aware under certain circumstances there is a big cash requirement, and I better have other provisions, either through the other types of assets that I hold in the plan that I can liquidate in a fairly reasonable perspective, or I better think twice about getting involved in these types of things. Let's now focus on the last piece of what I want to talk about, and it's probably the most important, and that is, okay, GFC exposed these vulnerabilities. We weren't diversified enough. We didn't have sufficient liquidity. What do we do? And so I want to talk about how we look at these factors and how we can think about using them in a more prudent way that leads to not only better performance during the GFC, but over the long term, substantially superior performance relative to the risk that's taken. Here are what I think are the basic principles in building a more resilient and more efficient long-term portfolio. One, allocate risk, not capital. We talked about that it's the amount of risk you take and that creates the exposure to an asset, and that's going to drive your expected return. Two, build an allocation that is more responsive to a variety of economic factors and therefore builds in greater consistency. I'm going to show you how we can do that in a few minutes. Number three, once we've got this more diversified portfolio, let's be more prudent about how much risk we really want to take and therefore the expected return associated with it. And lastly, as we talked about, be aware of what you have and what could potentially lead to major cash calls in the portfolio, and make sure if you're going to get in those types of things that you have sufficient liquidity. I want to do a very simple example to illustrate a very important concept here, and what I want to do is just focus on stocks versus government bonds. So in this case, it's global stocks versus global government bonds. And go back, 40 years, long-term time frame, et cetera, et cetera. And the picture that you see here at the top is the one, that we've experienced, what global stocks returned, which is the black line over that period of time, versus what global bonds returned over that period of time. And lo and behold, no surprise, stocks earned a higher return. That's why most plans have a heavy allocation of risk to stocks, because if I want to earn a high return, the only asset that really generates that kind of high return and has reasonable liquidity is an equity portfolio. But when you look at it, what you also see is, yes, stocks perform better than bonds, about 2% more a year, so double the return, excess return, but it did so through taking roughly 4 times the risk. And then, in fact, if you actually look at the return per unit of risk over this time frame, what you see is that return per unit of risk was actually much higher in the bond market, the 0.39, relative to what was experienced in the equity market, which is 0.25. Now, some of this is time specific, but if you think about it logically, there's no reason that any asset class should necessarily return structurally a higher return per unit of risk. Because basically, investors are smart. If investors find places that can provide a higher return per unit of risk, I'm going to put more money, drive up prices, drive down the return per unit of risk. And conversely, at the other end, if they're expensive, I'm going to not invest. That'll drive prices down and make them more attractive. So there's a natural mechanism over time that should bring the return per unit of risk of all asset classes in a much more similar way, comparable. An implication of that is that if you now turn around and say, okay, the dotted line are the bonds that we normally invest in, the normal government bond index. But now what I want to do, the risk and return is too low. I want to increase both the risk and the return I get out of the bonds to make it look more like equities. Well, it turns out if I turned around and leveraged the typical global government bond portfolio 2.5 times, I get the impact of the blue line, which basically would have given me the same return as equities and yet still less risk. And so if I can take this same kind of approach to any asset class and say, look, if I can just adjust the risk to make it similar to the risk of equities, I can generate the same return as equities. I don't have to chase equities to generate return. And therefore, I can build a more efficient, more diversified portfolio without giving up return. Now, okay, everybody's reaction, that's all well and good, but leverage is bad. Well, I'm not sure that's true, and I believe personally, I think I've talked about this in the past here in these conferences, that I think a leverage in and of itself is very misunderstood, that leverage isn't risk or risk increasing. Leverage is just a risk adjustment vehicle. And where leverage has led to problems are because people have used leverage to take too much risk. But if I use leverage prudently, I can reduce risk because it can help me diversify the portfolio in a more efficient way. And so using leverage type techniques, leverage, I don't believe, as long as you use it in a reasonable way and keep risk in a reasonable way, is necessarily a problem. I mean, isn't it interesting that the reason equities return higher returns at higher risks is because companies are leveraged? If companies were not leveraged, the returns and risk of equities would look a lot more like bonds. And so on one hand, we say, well, it's okay if a company goes out and leverage, and I'll just invest in that. But if we go out and buy a government bond portfolio and we put similar type leverage on, that's a bad thing. Now, to me, that doesn't make sense. But yet, that's where regulators have necessarily gotten to. Okay, leverage, if used prudently, I believe can lead to much more efficient portfolios. But guess what? What if you can't? I don't want to lever bond portfolios. I can't. Either my regulators won't, my investors won't, et cetera. What you can do in the bond market is just lengthen the maturity and duration of the bonds that you buy. So here, all we did was, instead of buying the normal government bond index, which includes a lot of shorter maturity, shorter duration bonds, that we turned around and just bought the 10-year plus government bond index. And so we weren't able to get the dotted line all the way up to the blue line, but we certainly got it a long way higher, such that I'm taking more risk and much higher return. The only reason this only goes back to 1987 is the 10-plus government bond year index only started in 87. We couldn't get actual data prior to that. But if you took this back to 1970, which included the period of the inflation period where rates rose dramatically, and then the subsequent fall down, you still get basically the same kinds of numbers. They won't be exactly the same, but the benefit we're talking about would be very similar. And so all I'm trying to illustrate is, even if you're uncomfortable with leverage, which I would argue people shouldn't be as uncomfortable as they are, there are techniques where you can just get more risk out of the money you're putting in bonds, and therefore can take more risk in bonds than you can in equities. And again, it allows you to not put so much, not be so reliant on equities, and contribute to the lack of diversification. Now, this is what I showed before. Here is the lack of diversification, right? And so what can we do, given what we just talked about, what can we do to eliminate that heavy red on the right side? In fact, asset classes have very predictable return characteristics to economic drivers. And it's pretty consistent. And so what happens is, I buy a portfolio that is very dependent upon a particular environment. The environment changes, and the relative relationship between various asset classes change, i.e. the correlation number shifts. So rather than worry about a number, what I really want to do is find assets that respond to different economic conditions in a positive way and diversify across those economic conditions such that no matter what happens going forward, I've got assets that do well. What do I mean by that? First one right here, page just shows one of the major drivers of asset returns is growth. Is growth ending higher than what the market priced in or lower than what the market priced in? And if that happens, what happens to certain asset classes? And so you can see on the left here, we just took back history back to 1970, carved up those periods when growth was stronger than expected, and lo and behold, what you see during those periods, assets that are reliant on strong growth, equities and commodities did very well. And so, okay, we've got a room in a portfolio for that. But we also know there are periods when growth is much weaker than was priced in. And in that kind of environment, it's exactly the opposite. Equities and commodities do poorly, but bonds, nominal bonds, and inflation index bonds do very well. So again, certain assets do well, and assets respond to different economic conditions in a very predictable way. Let's look at the other major economic environmental influence, and that's inflation. Similar thing, when inflation is much higher than expected, inflation index bonds and commodities, those assets that respond to inflation, did very well. Conversely, if you have an environment where inflation ends up much lower than expected, it's equities and nominal bonds that do well. And so, this is why the relationship between various asset classes shift, because you don't know at any moment in time, and it's very hard to predict on a going forward basis, is growth going to be stronger or weaker than expected? Is inflation going to be stronger or weaker than expected? And how do I sit and build a portfolio that allows me to, work through any environment in a reasonably constructive way? And so ideally what we want to do is these are, we call sort of the environmental sensitivity boxes, if you will. The left is the typical portfolio. It's heavily equity dominated. Well, it's going to do well. There's big yellow and big green. Why? Because big yellow is that portfolio is going to do well when growth is stronger than expected, because that's good for equities. And it's going to do well when inflation is lower than expected, because that's good for equities. But in the other two environments, it gets hurt rather dramatically. Whereas if we could construct a portfolio that's equally balanced across these economic environments, no matter what mix I get going forward, one of those boxes or two of those boxes are going to be doing well. And so I get a much more consistent return. And if I can do that without sacrificing longer-term returns, I'm in a much, much better position. And so if you go through that exercise, and we can talk more detail if somebody wants later, what you end up with is the left was the risk allocation of the typical plan as it exists now. The right is the risk allocation of this more environmentally balanced portfolio. Okay? It is very clear it's a much more diversified portfolio. But what does that mean to returns? Let's look at the crisis. Okay, this is what, if you held the balanced portfolio versus the typical asset allocation, what would have happened in the crisis? One, you'd have made more money from the blue line, largely because the decline was far less deep, and therefore the recovery out of it was more achievable than in the typical portfolio. Typical portfolios we talked about earlier dropped 35%. And it would have taken 53% of positive returns to overcome that. We haven't seen that yet. Whereas in the balanced portfolio, you only would have lost the drawdown 12%, and only took 13% to recover, and we've more than seen that. And so this better balanced portfolio, for logical structural reasons, is much more resilient than this equity-dominated, bet on strong growth, low inflation portfolio that everybody seems to hold. Okay, so it's more resilient during the crisis, but what about longer term? And here we go back to 1970, and you can see, and again, this is somewhat time period specific, but what you see is over a 40-year period, this better balanced portfolio would have out-earned the typical asset allocation by something like 6% a year. Well, I think that's artificially high. I think that's time period specific. But what I do know is structurally that advantage should be significant, at least double. Because it's a better balanced portfolio, more resilient, and what it does is it reduces those big drawdowns, those big periods of losses, which again are very hard to overcome. So basically, just in summary, and then I'll be happy to answer whatever questions anyone has, when you look at the impact of the GFC and what it means to investors, is that basically superannuation plans, and just like all institutional investors globally, were exposed to a lost decade. No money's been made, and a lot of risk has been taken for a 10-year period of time, which is pretty significant. Why? Because most portfolios were over-dominant in equities, and we're betting on a certain environment, and that a certain environment obviously didn't happen on a number of occasions over the past decade. and that a better balanced portfolio that's more sensitive to balancing the economic implications, as we demonstrated, is more resilient during a crisis. But equally important is a better structural portfolio and delivers a higher return per risk even over normal times. And then lastly, the liquidity issue, just be careful that there's enough liquidity given the types of investments that people to get in that even in a crisis, it allows one the flexibility and maneuverability.